Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Along with my colleagues bring you a variety of perspectives. Today, I'll be talking about why being negative on credit isn't as obvious as it looks, despite historically low spreads. It's Friday, July 19th at 2 p.m. in London. We're constructive on credit. We think the asset class likes moderation, and that's exactly what Morgan Stanley forecasts expect. Moderate growth, moderating inflation, and moderating policy rates. Corporate activity is also modest, and even though it's picking up, we haven't yet seen the really aggressive types of corporate behavior that tend to make bondholders unhappy. Meanwhile, demand for the asset class is strong, and we think the start of Fed rate cuts in September could make it even stronger as money comes out of money market funds looking to lock in current interest rates for longer in all sorts of bonds, including corporate bonds. And so while spreads are low by historical standards, our call is that helpful fundamentals and demand will keep them low, at least for the time being. But the question of credit's valuation is important. Indeed, one of the most compelling bearish arguments in credit is pretty straightforward. Current spreads are near some of their lowest levels of several prior cycles. They've repeatedly struggled to go lower. And if they can't go lower, positioning for spreads to go wider and for the market to go weaker, well, it would seem like pretty good risk reward. This is an extremely fair question, but there are 4 reasons why we think the case to be negative isn't as straightforward as this logic might otherwise imply. First, a historical quirk of credit valuations is that spreads rarely trade at long-run averages. They are often either much wider in times of stress or much tighter in periods of calm. In statistical terms, spreads are bimodal, and in the mid-90s or mid-2000s, they were able to stay at historically low levels for a pretty extended period of time. Second, work by my colleague Vishwas Patkar and our U.S. credit strategy team notes that if you make some important adjustments to current credit spreads for things like quality, bond price, and duration, current spreads don't look quite as rich relative to prior lows. Current investment-grade spreads in the U.S., for example, may still be 20 basis points wider than levels of January 2020, right before the start of COVID. Third, a number of the key buyers of corporate bonds at the moment are being driven by levels of yield, which are still high, rather than spread, which are admittedly low. That could mean that demand holds up better even in the face of lower spreads. And fourth, credit is what we call a positive carry asset class. Sellers lose money if nothing in the market changes. That's not the case for U.S. Treasuries or U.S. equities, where those who are negative or short will profit if the market simply moves sideways. It's one more factor that means that while spreads are low, we're mindful that being negative too early can still be costly. It's not as simple as it looks. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.